Good morning and welcome to this Wednesday, September 28th, 2022 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, futures were a little rough overnight, but they have improved. That's a good thing. We are still flirting with those lows from June, went a little bit below intraday yesterday. Of course, a couple of days ago, we had the close below the June low. I would still call this basically a double bottom at this point. Kind of said the same thing when we were just above those lows. Anything in this range, I think I would consider, maybe give or take 1% or so, I would consider a double bottom. So many times we do bounce off that. From a long-term perspective, the channel, if for those of you that have followed the show for a while and have followed us here at Earnings Beats. I talked back at the beginning of the year about a channel connecting the 2009 low after the financial crisis and then the 2020 low. And I dragged that line up to the highs, created that channel. And then I had a middle line going in the middle of the channel where many intermediate term lows have come down and hit. We are sitting on it right now. I mean, again, no guarantees, but this has been a critical area throughout this channel of where we've seen market bounces. So we are going into October. We're getting away from September, just a couple more days of September. So we're getting away from the worst month of the year, and we're actually moving into the best quarter of the year historically. So that at least should give us some tailwinds as opposed to the headwinds we've been trying to fight. And it's been a rough go here really since mid-August. Another piece of historical information that I talk about a lot is how the first half of calendar quarters tend to do much better than the second half of calendar quarters. So for instance, July 1st to August 15th tends to be much stronger than August 16th to September 30th. We've certainly experienced that. I mean, almost, it's been history on steroids this quarter. We went straight up, if you recall, from early July right through the middle part of August. And that's when we topped. We had a lot of in-the-money call premium, if you remember, for options expiration week. Talked about maybe things might be a little weaker in the near term at that point, wanted to be really cautious. Well, we went down. We hit, I think, just below the 20-day and started to turn back up again. And then that's when the Jackson Hole speech hit back on Friday, August 26th. Then we turned back down again. And it's been pretty much straight down ever since. Hot CPI report for August that came out, I think around September 10th or 12th or something like that. That added fuel to the bear's fire, to the downside. And we've been going down ever since. And now here we are finding ourselves back down at this June low again. A lot of the same indicators, bullish indicators that I saw back in June are present right now. Equity only put call ratios in the extreme level. The VIX is actually higher. The VIX is up into the 30s. We've got rotation still moving into bullish areas. All those things are still in the bulls camp or on the bulls side of the ledger. But right now, the market doesn't seem to care. And honestly, I was talking to my partner, John Hopkins, yesterday for a little bit in the afternoon. I just felt like the market needed to go down one more time, really create that last bit of fear and panic. And then let's see a big recovery off of it and mark a bottom. Can't recall a time when the VIX has been in the 30s. The equity only put call ratio is up above 0.80 on a 5-day moving average. And the S&P 500 is just sitting flat most of the day, most of the afternoon, doing nothing. It was just weird. Anyway, let me go ahead and get things started here by taking you over to earningsbeats.com. For those of you who are new, if you go to earningsbeats.com, scroll down, we do have a free newsletter. Also takes a name and an email address. You can hit that subscribe button. You're good to go. No credit card required. You can unsubscribe at any time. 3 times a week newsletter focusing on some of the things we think are really important at Earnings Beats. So mostly looking at earnings, gaps, price support, relative strength, those types of things. The one I did for this morning was on price support, and I'm going to show you that chart in just a little bit. I mean, when a stock goes back and hits the same level of support 8 times, you've got to believe that it's going to hold. No guarantees, but that's a strong support level. If you went down, if you're in a stock, it's $100 stock and it went down to 90 last week and now it's at 100, it goes back down to 90 again. You can look at that prior support and say, okay, the 90 is where it bounced last time. That's what I'm going to look for this time. But when you've gone back to that 90 level 7 previous times and bounced, starts to give you a little bit more confidence on the trade. And you know what? If you have to put in your stop a little bit below that level, then you do it. But anyway, that was a focus that I was on with today's Earnings Beats Digest. And I'll show you that chart in just a little bit. But again, go over to earningsbeats.com, scroll down, make sure you sign up. We do have free events, and we're going to have one coming up. I'm not ready to make the announcement just yet, but we've got one coming up probably in the beginning of November. It's going to be a really intriguing, eye-opening kind of an event. It'll be a free event. And everybody who is on the Earnings Beats Digest newsletter is going to get an invite. So it's another reason to be part of our community, because when we have these free events, we make sure that our EB Digest community is invited and pass along room instructions and those sorts of things. So make sure you get signed up. All right. So today, what I wanted to do here on the daily market recap, normally I have everything set up, to talk about the various indices and sectors and so forth. But I just wanted to point out, as you look at this, first of all, we had bifurcated action yesterday. Dow Jones down, S&P down, NASDAQ was up. NASDAQ 100 was up. Small caps were up. Mid caps were up. This is after the S&P. We didn't have a big rally back, but the S&P 500 went below a major low, a very significant low, in my opinion, back at the June low. That was 36.36, if you recall. The S&P 500, we'll pull it up in a minute. Actually, I can take a look at it real quick. The low was 36.23. So we were 13 points below this prior low. We'd already set a new closing low. If you look at the last, I don't know, what is that, 12, 13 trading days? We've had red candles almost every day. I think we've had 2 up days in the last, let's count them, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Last 11 trading days, the S&P 500 has been down 9 of them. So this has been a really rough stretch. And then we break down the VIX in the 30s, put call ratio way high. I was just bracing for a big sell-off yesterday afternoon. And then the S&P 500 rallied back 25 points and finished down 7. By the way, 10-year Treasury yield continues to go up. That was the other thing I wanted to show you here. 10-year Treasury yield, we're today down 13 basis points back to 383, but earlier we were up over 4%. So very interesting. Here, let me pull up that 10-year. So yesterday we got up to 3.99. Earlier this morning, we briefly touched 4%, and now we're just coming straight down. Now this has been a really, I think this has been one of the most bearish developments for the stock market, because as the yields keep going up, of course, everyone's getting out of bonds, but they're also getting out of stocks, because the folks that are getting out of bonds are not getting out because of a strong economy. That would be good for stocks. Normally what we see is when the yield goes up, stocks go up as well, because it's money coming out of the bond market that usually rotates into equities. But folks aren't selling bonds for that reason. They're selling bonds either for inflation, or they're selling bonds because they know the Fed's going to be selling bonds. Got QT. So there are reasons why folks are getting out of bonds that doesn't benefit the stock market. So this is one of those unusual periods where the yield's been going up, stock market's been going down. We've been seeing that all year. You might think from a common sense standpoint, that makes sense. Well, if rates go up, that's not good for stocks. That's not the case at all. Usually when rates are going up, it's because the Fed's fighting a strengthening economy. They want to kind of moderate the growth. So that's not what we've been seeing. Anyhow, the fact that the yield's coming back down, if that continues, I'd have to see that as a positive for the stock market, especially if you just look at the correlation in 2022. Yields go up, stock market goes down. When the yields have pulled back, stock market's gone up. That's the way it's been all year. So I find this to definitely be a bullish thing. We need to see stabilization of interest rates. Anyway, that's all I wanted to go over for the daily market recap today. I just wanted to do a little bit different today. Just to, and we could go over here and I could show you the sector summary, by the way, if you want to see what was working. Yesterday, energy went up. Of course, we had crude oil prices stabilizing. They were up a little bit yesterday. Consumer discretionary. Here we are again. I'm talking about a breakdown beneath a big low. We've been down 9 of the last 11 days. It's been horrible. And here we see two of the most aggressive sectors, consumer discretionary and technology, both gaining ground yesterday. Down on the downside, consumer staples, utilities, real estate. These are defensive groups. Now, for anyone who's new, probably, hasn't followed me for a long, for a lengthy period of time. Back in December, the opposite was happening. The stock market was breaking out, trying to break out, and being led by defensive groups. That was a warning sign for the bulls. Now, the market is threatening a massive breakdown, and it's being led by defensive groups. I think it's a warning for the bears. I mean, this is the type of rotation that I've been talking about that normally helps us to carve out a bottom. And yet, retail traders, the options world remains extremely bearish. You talk to anyone on the street, the market's going lower, inflation, interest rates, debt, everything, housing prices going back up or have been going up. But now with interest rates going up, affordability is going down, all these negative things that everyone's talking about. But that's what the stock market priced in the first half of the year. Stock market looks ahead. It doesn't look behind, or it doesn't even look at today. A lot of times you look at the market and you say, wow, we had some horrible news come out today and the market's up. How does that happen? Well, first of all, the stock market's looking 3, 6, 9 months ahead. It doesn't care what's happening today. You might get headline stories and they might pin it on the news today, but the stock market's pricing in what's going to happen. And that's why I think we're going to see rates coming back down. I think we're going to start to see deflationary pressures. I'm going to show you in just a second. We're starting to get deflationary pressures already. It's just that it's not coming out in the news because that's not the, scare du jour, whatever you want to call it. That'll be next. Once we're done with higher interest rates and inflation, then the media can jump on deflation. That'll be next. Anyway, the rotation I think is really important. So 10-year treasury yield. Let's take a look at it on the chart here. And I could go down here below. Let's get rid of this and let me just show you. Oops. Let's just go with the S&P 500 down here. I mean, if this doesn't look like, mirror image, I mean, as the 10-year treasury yields going up really started to break out in January, the market started to break down in January. I mean, there were a couple of times, like back in March here, we had a little run up with yields moving up. But outside of that, for the most part, I mean, here we're going up, yields are going down. When we finally had the S&P 500 rally, it rallied when the yields were coming down. Then as soon as the yield broke back out above this channel, right about in mid-August, went back through the moving averages, right then is when the selling starts. So I guess it just stands to reason to me that if the stock market's going down with yields going up, that if we do see a pause or at least a temporary decline in yields, we should see a rally in the stock market. Now, how far do we go in on the S&P? Well, that remains to be seen. I think we got to watch the 20-day EMA. I think 3,900 is going to be a big level when we get back up there. So those are, two things that I would be watching for. Now, before I leave this chart, I'm just going to go over economic news from this morning. So I'm going to go over August wholesale inventories, which August wholesale inventories rose 0.6%. That was last month. That was the July. August came out this morning. The expectation was a rise of 0.4%. We rose 1.3% on wholesale inventories. Listen, this is just all making sense to me. When you've got 2 quarters already of negative GDP, and the Fed is bound and determined to kill demand to get rid of inflation, what do you think is likely going to happen? Companies are not going to be able to sell their goods. And as a result, we're going to start to see inventories build. What happens when inventories build at the same time supply chain disruptions start to catch up? So now all of a sudden, supply is starting to get back closer and closer to normal. And all of a sudden, we have this sudden downturn in demand. Kind of makes sense. Inventories are going to begin to rise. August wholesale inventories were expected to rise 0.4%. They rose 1.3%. August retail inventories, I didn't see the expectation, but what I can tell you is that August retail inventories jumped 1.4%. July was 1.1%. We are seeing inventories build. This is the leading edge. It's kind of like, the leading edge of the storm, the storm surge. And by the way, for any of you down in Florida, thoughts and prayers are with you. Big day today. This is when Hurricane Ian is going to come ashore. I've got a sibling actually down in the Port Charlotte area, Northport. So that's right about where that hurricane's coming in. Fortunately, they're not there. They've gotten out of the area, but I am thinking about all the folks down there, all the way up the Gulf Coast, up to Tampa and all. Hopefully this thing lightens a little bit before it comes ashore. Anyhow, as I look at what's going on here in the market with all the supply build, the inventory build, the supply picking up, not where it needs to be just yet. We're still trying to catch up, but it is getting better. More and more companies are starting to talk about their supply chain disruptions are being less and less. There's still a lot of them out there talking about it being an issue, but it does seem to be getting somewhat better. And I think all of this is going to come to a head. And just like that storm surge that leads that hurricane, I think we're starting to see inventories build, which can lead to deflation. Now, deflation and disinflation are two different things. Disinflation is just the lowering of inflation. That's what we want. Deflation is where you can start to see prices spiral downward. Deflation is much worse than inflation. So the Fed better be really careful about, already some of the Fed officials are saying, you know what, we may be getting close to what we needed to achieve. A couple of them are already out starting to whisper little things like that. I think they're going to lower rates. I've said this before. I don't know if it's going to be this year, but I believe in the first quarter at the latest, you're going to see rates coming back down. Because all they're trying to do is squash inflation. Once that's done, then their next mode or their next line of attack is going to be deflation and trying to get the economy pumped back up again. Squash inflation, pump up the economy. That's going to be mandate number one, and then mandate number two. Watch the 10-year Treasury yield. That's my point here. As it comes down, maybe we just get back down to the 20-day. I'd be back down closer to 350, 360. That would be the area where we broke out before. So it just seems like the natural move to the downside. If we go and look at the S&P 500, notice all of these tests. Remember, we've been talking about 3,900 for months. We had the double bottom here in May. Then we broke through gap resistance at 3,900, came up, put in a double top right near 3,900, pulled back, then broke through, retested 3,900. And then our last rally since mid-August was from where? 3,900. Then we're at last breakdown, 3,900. So if we do rally, it could be a swift one, especially given how fearful the market is with the VIX in the 30s, with the 5-day moving average of the equity only put call ratio back above 0.8. That could give us reason for a quick rally similar to what we saw a few weeks ago. And if we do that, maybe we get back to that 20-day, which is at 38.73 right now. And maybe intraday, maybe we go through the 20 and get back up to that 3,900 level. To clear 3,900 at this point with a double bottom in play would be very bullish in the short term. From a more intermediate term, watch 4,300 to the upside. I mean, you can see these rallies failed at 4,300. This one failed at 4,300. And then to the downside, this double bottom. I mean, are we going to hold? That's the big question. I think if we get a big move down in the yields, I would be very surprised if we didn't get at least a temporary bounce in the S&P 500 and in U.S. equities in general. All right, the NASDAQ 100 or the NDX, very similar. We are still holding on above the June low. And this is the more aggressive index, by the way. This is, you've got many, on a percentage basis, the NASDAQ 100 is made up of many more growth companies than the S&P. For one, the NASDAQ 100 doesn't focus on financial companies. Financials are more value oriented. And you got a bunch of financials in the S&P 500. So the fact that the more growth oriented NASDAQ is holding the June low, while the more, I'm not going to call, it's not value oriented, it's just more value oriented than the NASDAQ. The more value oriented S&P 500 has actually gone a little bit below this June low. That seems odd to me. Money is rotating a little bit more over the last few months toward the more aggressive NASDAQ, while everybody's growing more fearful about the market. Doesn't really add up. All right, let's take a look at, I'm going to go through and show you some companies that I think are testing some key support. And I'm going to start off with Qualcomm. This was the earnings beats digest chart for today. And I mean, I could annotate it, but I think if you look across the screen and you're at least somewhat familiar with charting and technical analysis, you can probably see that if you go back 2 years, this goes all the way back to the low set in October of 2020 on Qualcomm at 117. Here we come down, we get down to about 120. Here, 121. Here, 121. Here, 120, 121. Here, back down close to 117, 118. There, 120. Where are we right now? 120. I mean, count them. 1, 2, 3, 4, 5, 6, 7, 8. 8 times we've come back down to 117 to the 121 range. And 8 times we bounced. Now, maybe the 9th time, or maybe this 8th time, is going to be the one that fails. I don't know. But from a support standpoint, things don't get much better than this on a stock. I don't own Qualcomm right now, but I might before the day's out. This is one I'm definitely keeping on my watch list. If I believe the market's going to bounce, this is one I definitely like. I mean, the 20 days up at 127. So we could get a quick $7 out of it. I mean, we're talking almost 6%. That would be a nice little rally. That's, again, just to the 20-day. Maybe it goes through. It's gone through before on some of these others. But that would just be, you can see recently the failures at the 20-day. So if we bounce off this area and just get back to 127, nice little pop. Let's go on and let's look at Checkpoint. These are all NASDAQ 100 stocks, by the way. So when I was looking at NASDAQ 100 and I saw it hitting this support, I just thought to myself, okay, wonder how many of these NASDAQ 100 stocks are at a key support area. Well, Checkpoint getting pretty darn close to one. You can see the low here back in March 2021, right near 110. We went just a little bit below 110 back in December. Yesterday's low, 110.26. I mean, recently back in March, we were $150 stock. This 110 area, pretty big. Moving to the biotech area. And I don't know if you've noticed, I'm going to show you something, but over the last month, the S&P 500 well, yeah, from the last month, it was August 27th, that Friday. That was when Fed Chief Powell came out with his Jackson Hole speech. So we've now been 1 month from there. Do you know, even though the market's been going straight down, the top 5 industry groups during the last 4 or 5 weeks, top 5 industry groups have been aggressive industry groups: renewable energy, automobiles, specialty retail, apparel retail, restaurants. What the heck are these leading during this pullback where the Fed's telling us rates are we've got more pain ahead? Why is Wall Street moving into these other groups while the headlines are just telling us how bad everything is? I'll show you the relative strength chart in just a minute. Anyhow, just wanted to point out that's where these NASDAQ 100 stocks are coming from. So INCY, this is a pretty big biotech company. And you can see recently 62.5. Here we're 65, 66, 65, 66. Yesterday, the low 65.88. I mean, we're right in here, getting down close to support level. Now, if the market falls apart, you got to make sure you keep your stops in play. I'm not saying you just buy these things and open them up again in a year and see where they stand. I mean, if the market breaks down and we do morph into a secular bear market, last thing you want to do is hold some of these aggressive stocks for the long term. But as a trader, knowing that, hey, this is an area where we could get a bounce from, I think it's kind of critical to look for stocks that are at support, especially a stock that's in a strong industry group that's at support. All right. Also, what I did is I looked for some kind of significant positive divergences on the weekly charts on these stocks as well. So I'm going to show you first Align Technologies. So here you can see at the top, we actually started with a negative divergence back in the early part of 2021, latter part of 2021. Excuse me, you can see the negative divergences there. And eventually we rolled back over, couldn't hold the 50-week moving average. And of course, with everything else going on in the market, bear market territory began, or bear market season began back in January and started selling off. But a lot of these companies now have been selling off for a long time, and they're beginning to show slowing momentum. Now, I got to say that when a stock drops from $750 to $230 in about 8 months, of course, the momentum is going to slow. It almost has to, unless it keeps going straight to zero. Things are going to start to slow down. It's like you're coming down a mountain. Eventually, you're going to get off that mountain and it's going to get flat. And so you're just naturally going to slow down. That's what it looks like to me with Align and maybe some of these others. However, I do just want to point out lower prices, higher PPO, positive divergence on Align. How about eBay? Been going down, 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 keep failing at the 20-week moving average. Look at the lows, though. Low, look at this PPO. Now, when I see a divergence, we don't know. I mean, prices could keep going down. The PPO keeps going down. It's almost like right here, when we first broke down below this low, it looks like we probably had a positive divergence. But we kept going lower, and the PPO went lower. This is what a lot of folks that point out divergences don't talk about. Divergences can be eliminated. A lot of folks say, oh, there's a positive divergence, I'm going to jump in right now. I think you want to get a little bit more confirmation. For me, that's a reversing candle. So maybe a strong finish to a week would help. Maybe eBay comes back up and goes back above 40 at the end of this week. To me, that would be a much more significant positive divergence to play, because then you're seeing signs of a reversal and a positive divergence. So something to think about or look at. The last one I'll show you is Meta Platforms, formerly Facebook. I mean, this is another one that's been down here for a while. It's gone from 380 down to 134. It's also getting close to 5-year support. I'm not a big Meta Platforms fan, but I mean, I got to admit, it's getting close to an area that's getting tempting from a long perspective. Anyway, those are just some of the stocks I wanted to point out at major support or with divergences. Last thing I want to do is just go through. I'm going to combine the earnings spotlight, the 3 you must see, and I'll just give you 3 charts. Actually, no, before I do this, I did want to give you this relative strength chart. Sorry. So this is over the last month. So this goes back basically to when Fed Chief Powell gave his famous more pain ahead speech from Jackson Hole. The market had one of its worst days. What I thought it was the worst day since the June bottom. One of the worst days of the year, but definitely since the June bottom. Since that time till now, renewable energy has been the best industry group. Pharmas, which are a little bit more defensive, are number 2. Autos, biotechs, specialty retail. Wait a minute. We got this nasty recession ahead of us, right? Specialty retail is the 5th best group. Don't listen to what they're telling you on CNBC. Look at where the money's going. I can't tell you for sure that the stock market's going to bounce from here. All I can tell you is that I'm seeing money going into aggressive areas over the last month while the market's gone down from 40, well, maybe 4,200 to 36 something. Normally you would see aggressive groups leading to the downside. Instead, we're seeing some of the most aggressive areas leading to the upside on a relative basis. This doesn't tell us that they're all going up. It just means that they're outperforming the S&P 500. Money is rotating into these groups. Why would that happen? Why would you be buying specialty retail stocks ahead of economic disaster? That's what we're being told is going to happen. Rates are screaming higher. Wall Street is not positioning for economic disaster. So why should we? Healthcare providers, number 6 spot. Restaurants, 7. Apparel retail, 8. Go down a little bit further. You got a couple financials, insurance brokers. I mean, you still have some on the downside that concern me, but I would have expected consumer staples, utility groups. Look at the last month, market absolutely collapsing. And on the top 15 or 20 that I'm showing right here, not one utility group. There are a couple healthcare, but like I said, the highest or second highest healthcare group is biotechs. That's not a defensive area. That's a very aggressive area. If we look at the bottom of what's going on at the bottom, aluminum, tires. I mean, I'm just looking at the sectors coming across here. You got materials, staples, real estate, materials. There's an industrial delivery services thanks to FedEx. Energy, industrials, transportation services, kind of that same line. Materials, real estate, and there's communication services. This is more aggressive. Broadcasting and entertainment, energy, real estate, materials. And then you've got the one discretionary group. Where's technology down at the bottom? Anybody see any technology? I'm just saying, evaluating the stock markets more than just looking at the S&P 500 and looking at whether we set a new low. You should go back and see the new lows that were set in March of 2009 and check out some of these relative ratios that I like to look at. They were all turning up. And so right now, as the market's trying to go lower, we're seeing these ratios turn up. Again, I can't promise anyone that the stock market's going higher. I can't guarantee that a bottom is in. But you're not getting the whole story by looking just at the S&P 500. That's my point here. Anyway, let's wrap it up quickly with 3 stocks. These are 3 companies that will be reporting earnings sometime in the middle part of October. So they're going to be early. I did this yesterday looking at JP Morgan and a couple others, I think Pepsi and UNH, United Health. So let's look at 3 more today and see how they're performing. IBM, remember IBM when it looked like, hey, we're going to break out back here in June? Oh no, now we're going to break out in June. Nope. Now here comes the rally in August. We're going to break out. I can, go and show you a 10-year chart or a monthly, look at a monthly 15-year chart on, I don't want JBHT. Let's look at IBM. We've had a massive bull market since 2013. You would never know it on IBM's chart. IBM back in April of 2013 was trading at 140. That's when the S&P 500 cleared 1,550. Remember that double top from year 2000 and 2007 on the S&P at 1,550-ish? We broke that in April of 2013, and the S&P went from 1,500 almost 5,000. IBM during that period went from 140 to 120. Well, at the high, 140 to 140. It went nowhere while the S&P 500 more than tripled. Watch IBM, because a breakout above 145, I think, would be incredibly bullish, but that's not what we're dealing with right now. So let's go back to this chart. I mean, we've been downtrending. The AD line, it still looks like Wall Street's accumulating the stock. We do have some support area that we can focus on between about 117 and 120, or 117 and 122. And that's about where we are right now, right in that range. So this is another stock that could bounce. But when I look at the group, it's been going down. IBM is actually still a leader within the group. It's just that the group's been so weak. So maybe IBM's going to deliver the goods. Be an interesting one. Maybe a possible pre-earnings run up there in IBM. JBHT, AD line looks pretty good. Truckers, yeah, still holding on to the June low. That's a good thing. JBHT, not bad over the last year. I would say it's above average trucker. So we're going to want to see how this report comes out. I would expect that 155 support area to hold. Last one I'll give you today, CMA Comerica. This is one in the banking area. Recently, it was actually, doing pretty well. You can see the relative strength. We actually, back at the beginning of this month, set a new 52-week relative high. So when you look at the price action, it looks horrible, but it is holding on to the lows from May and July. Banks actually are down just beneath that low from July. So on a relative basis, CMA is doing a little bit better than the group. It's holding support. What would not be good for the group is for CMA, which is one of the leaders, to come out with a poor report and to break down. That wouldn't bode well for the rest of the group. So I'd be looking to CMA as being one of the leaders in banking, and it's going to be reporting fairly early. How does CMA perform? That's going to be something to watch. What's the reaction after earnings? All right, let's see what the market's doing and see what that 10-year is doing. So right now we've got the Dow down 11, S&P down 4, NASDAQ down 43. So on a percentage basis, we're seeing the NASDAQ underperform a bit. New York Stock Exchange, though, is green. Small caps, mid caps, green. The VIX up another 3.5%, almost 34. We've seen some major bottoms in the market and major tops in the VIX when the VIX gets up to that 36, 38 area. We're almost there. I'd actually like to see the VIX top with a slightly lower top than what we saw back earlier this year. I'm just looking at the 10-year Treasury yield. Yeah, still down 14 basis points. I would expect if the yields stay down that we'll get a rally later today in the market, but we'll see. Market's crazy, kind of does its own thing sometimes. But just don't forget some of the things we talked about here, especially that relative strength of the industry groups. I'm actually, for our members, going through right now and doing a pretty comprehensive study on Excel, looking at all of the industry groups since that June bottom, and going to have that available for our annual members probably over the next couple of days. That's my goal anyway. So I'm trying to work on that. So keep that in mind and be looking out for that. Anyhow, everybody have a great day. I'll be back tomorrow over at Stock Charts TV. Just simply go over to Stock Charts TV tomorrow at 9 a.m. and click on it, and you'll come right in. That's a free part of their website. So you don't need to be a member at Stock Charts, but you can come in and listen to the next show. This is a critical time. We'll see where the market is together, and we'll go from there. Everybody have a great day. Happy trading.